thank you for that very kind introduction, Richard, and thank you to Michael for having me. It was actually 20 years ago this month when I had the privilege of working here in Canada for the government with some McKinsey partners of mine to look at the future of the Canadian financial system as part of your regular reviews of what's going on here. We were asked specifically to, over the course of a year, to answer two questions. How was Canada doing from a competitiveness standpoint, and how well served were Canadian customers? So whether you pause and reflect over the course of a year or just in a single day conference like we're having here today, I think it's a healthy thing to do. I'm going to focus most of my remarks on what is going on in my home country, the U.S. I reserve the right to stray into some global issues where I think there are some common points that I'd like to pick up, and hopefully you'll find some lessons learned from my remarks, recognizing that the U.S. and Canadian financial system and regulatory system are radically different. So I'd like you to take away three things today, and I'm just going to jump right into it. First thing is that, from my perspective, I think President Trump's reform agenda, broadly defined, is at risk due to the continuing dysfunctional style of governing that we've seen so far in the first 5 months, and what I will define as the general political disarray in Washington. And unfortunately, I think he is likely squandering a unique opportunity to get some serious issues on the table, whether it's financial services, tax reform, pick your favorite issue. But particularly in financial services, I think there's an opportunity to better balance the very real needs for financial stability in any financial system with a more moderated view of how we sustain economic growth going forward. From where I sit, the probability of legislative reform or legislative relief actually is quite low. It's going to be a long, difficult process for a variety of reasons I will get into. I think you'll see most of the major core reforms that have been enacted to date stay in place with some tailoring and recalibration, particularly for smaller community banks, maybe some mid-sized regional banks, maybe the custody banks get lucky with a couple of regulatory changes. But the chances for reform there, in my opinion, are low. The probability of getting more reform at the regulatory and supervisory level, contrasted to the legislative level, I think are a bit higher. There's a phrase in Washington, may apply here as well, that personnel is policy. And I'll go into some of the personnel changes and the likely changes there. But the regulators do have a degree of flexibility to make changes, and they are starting to signal that now in the Trump administration, where we saw them for the past 8 years very unwilling to engage in either private or public conversations about the need for potential recalibration. Now, in the interest of full disclosure, one of my clients in Washington is a middle-of-the-road think tank and advocacy group, the Bipartisan Policy Center. And Jason Grimay, who's the president and CEO, had this comment after the first 100 days of the Trump administration. It's quite provocative, but I think it's also quite accurate for the situation we face in Washington. And he said, and I quote, "President Trump's candidacy in early months in office reflect confounding paradoxes. Trump's a fire-breathing absolutist and pragmatic deal-maker. He's a populist rebel and a super-rich power broker beholden to Goldman Sachs." Jason speaks in quite colorful language, if you hadn't picked it up. Ultimately, these contradictory personae are resolved, will determine if we can transition from a campaign fueled by grievance to the generative work of governing. And that's going to be the challenge going forward. How do we govern in financial services, tax reform, trade reform, whatever it might be? Now, during the campaign, candidate Trump talked about, we're going to repeal the Dodd-Frank Act. Once getting elected, President Trump spoke in more moderating terms. So one of his first comments was, we're going to do a very major haircut on Dodd-Frank, whatever that means, all in the name of making sure that banks can lend into the real economy on a sustained basis to create jobs. At another function with community banks several weeks later, he extolled the virtues of small community banks, of which we have thousands across the United States, and noted again that Dodd-Frank was out of control and he was going to do something about that. And if you can discount a lot of the silliness and the noise and the tweets coming out of Washington, and confine our discussion for the rest of my remarks on financial services, I would argue that he and the folks around him are actually doing some quite thoughtful, considerate, moderate reforms to put the foundation and the building blocks in place to think about how we want to adapt regulation to make sure we can grow the economy and create jobs. He's issued a whole series of regulatory executive orders. I won't go through all these. I will focus on the second one there, the February 3rd core principles, which enunciated a set of principles and then also demanded a study which was just released by Secretary of the Treasury Mnuchin just last week. And there's some others that are coming. We talk about Orderly Liquidation Authority and the Financial Stability Oversight Council, or FSOC. Those reports are yet to come, but still important. Now, every one of our many financial regulators have their own core mission and set of goals as individual regulators for their individual responsibilities. We have nothing across the United States that says, here's a vision for our financial market and our financial system broadly defined. So President Trump's core principles stated this and at least set down a marker. Now, these are not binding in law, but at least it is his vision about how he wants reform to be measured going forward. And it's hard to take issue with any of these, and friends of mine in Washington, both on the left and right, Republican, Democrat, are buying into these. And it starts with, we want a system that's going to empower Americans to make independent financial system decisions and informed choices. We want to prevent taxpayer bailouts. We want to foster economic growth and vibrant financial markets through more rigorous regulatory impact analysis. We want to enable American companies to compete. We want to advance American interest in international financial regulatory negotiations and meeting. There had been some concern when he was first elected that the U.S. would be pulling out of Basel, pulling out of other international standard-setting bodies, and that's not to be the case. We want to make regulation more efficient and effective, and so on. Not a bad starting point to be. And as I said, just last week, Treasury Secretary Mnuchin issued a report building on these same themes where he talked about the impact of regulation and the importance of achieving growth and creating opportunities for Americans to benefit our economy. We're focused on encouraging a market environment where consumers have more choices, access to capital, and safe loan products. Again, while ensuring that taxpayers are not going to be bailed out in any future crisis. So that they very clearly have established a point of view, regulatory reform focused on growth and jobs. That can't be denied. And when you look at his core principles, it was not radical. It was not things that were picked up through the campaign. There was no Dodd-Frank repeal. Not even a very major haircut, as the President had threatened, but a series of refinements recommended to both Congress and the financial regulators. And again, in the U.S., the Treasury Department, the President can make these statements and make these recommendations, but certainly neither the President nor the Secretary of the Treasury can wave a magic wand and make things happen. That's up to the independent regulatory agencies. There was no 21st century Glass-Steagall Act included, and I'll come back to that in a moment, but there were major recommendations to go back and rethink the so-called Volcker Rule. I've talked about the focus on economic growth and jobs, and there was a heavy deference to encouraging both the Congress and the regulators to act. And I'll talk about the ones particularly as they apply to foreign banking organizations in just a moment. And there are more Treasury reports to come. So if you think that they may have stopped short in certain areas like market liquidity, innovation, asset management, insurance, cybersecurity, there is more coming down the road. For foreign banking organizations, hopefully you will find a number of the recommendations in the Treasury report to your liking. And note from this simple table that most of them can be done by the Federal Reserve on its own. It's only the first one dealing with the enhanced prudential standards and living wills for foreign banks that ought to be based on a U.S. risk profile and not your consolidated global profile, where Congress is required to act. In every case going down the list there, from the CCAR thresholds, other requirements for the intermediate holding companies, the Federal Reserve has it within its power to make these changes over the months ahead, and there's been some signaling to that effect, and I'll talk about that in a moment. And just 2 days ago, one of the principal authors of the Treasury report, Craig Phillips, formerly of BlackRock, now a counselor to the Secretary of the Treasury, was asked the question about what are the major themes that he wanted to convey to everybody in the audience. And so I will repeat those for you here, again because it strikes a resonant chord with both what other independent regulators are saying and what people in the U.S. Congress are saying. But he talked about three themes: tailoring of regulation to fit the risk profile of the financial institution or class of institutions affected. He talked about simplifying complex rules and overlapping supervision. And he talked about harmonizing regulation both within the U.S. and internationally. Now, again, this is not crazy statements coming out of the Treasury Department. This is a very temperate, I would argue, moderate approach to how we think about the recalibration and reassessment of rules and regulations in the U.S. So to date, the impact of what the President and his new administration has done is been modest, to say the least. But he is clearly signaling his direction. He's signaling goals. He's creating a radically different tone about how to have this debate in the U.S. than we've had in the past 8 years, where it's actually okay to talk about these issues, convene groups like this, get the regulators and the private sector in the same rooms to talk about issues of common interest. The mandates are helpful for the recent reforms going forward, and there's more action to come. He has, when he issues an executive order, President Trump can bind the cabinet agencies that report to him. He cannot bind or command the independent agencies. So these are of limited value, but nonetheless important. We're not preempting rules along the way. There's no private right of actions. But again, he has laid out his blueprint for the future that the Treasury Department in its first report and subsequent reports will follow. Now, one of the concerns is, for those in the room of you here today concerned about financial services, it's a bit down the pecking order of other priorities that frankly were of higher interest during the last presidential campaign and since he has taken office. So if you stop at the top, health care is a major issue in the U.S. A reform has passed the House. It's pending in the Senate. There's discussion of tax cuts and reform. We have all sorts of budget issues. We have something called a debt ceiling extension that's coming up that's going to cause problems. A lot of talk during the campaign, and this is where it gets both Republicans and Democrats excited about infrastructure repairs and getting something going in that area. Trade negotiation of keen interest here. And then all the national security issues and foreign policy issues that are on the President's plate. And then when we get down in kind of the 7th or 8th ranking, we have financial services. So a lot of these, and then we get to housing finance reform, particularly with our government-sponsored enterprises, the Fannie Mae and Freddie Mac. So lots on the agenda. There is limited time in the legislative calendar to do things. It's not, financial services reform is not necessarily the highest priority, but it is an important priority for his administration. The question will be, how much political capital and how much time is left in both the legislative session and with the regulators to get to this. One of the great distractions that you've probably all seen in the press is the concerns about the Russian impact on the last presidential election. And I'm not going to do that into detail other than to mention that currently we have 5 separate and I would argue competing investigations going on. One in our Justice Department, 2 in the Senate, 2 in the House of Representatives that are ongoing, they're active. They're looking at different aspects of what the Russians may or may not have done, subsequent actions by the President and his associates, both during the campaign and the administration. And then again, as you've seen in the press, the follow-up charges for what may have been done, if anything, when it comes to obstruction of justice. That all has to play out. The point I want to make is that it takes up time, it takes up energy of people within the administration, within the White House in particular, to deal with these issues, and puts aside other more important issues potentially that are on the President's agenda. And then you have just the general dysfunction coming out of the White House. How many of you follow President Trump on Twitter? Raise your hands. We've got a few brave souls. I do, because it's part of what I view as my job. You have the statements like the one that came out at the end of May, just after midnight, that you probably read about in the press, where he began the tweet, despite the constant negative press, covfefe, silence. These are not helpful, no less than our... no less a political leader than Mitch McConnell, who's the majority leader in the Senate for the Republicans, has encouraged President Trump to publicly stop tweeting, but I don't think that's going to happen anytime soon. So despite some of the dysfunction coming out of Washington, where I take encouragement is all the other things that are going on, and now I'll jump into some global issues, but all the activities that are going on to keep this current debate alive about impact of regulation on the economy, on jobs, and how to do some better balancing. It starts with the European Commission put out a very good call for evidence going back to 2015. The Financial Stability Board has a proposed framework for post-implementation evaluation. The U.S. Senate Banking Committee has its own version of a review going on and a call for evidence to look at financial services in the context of growth and jobs. The Federal Reserve just recently has signaled that, and I'll talk more about some things that Governor Powell has said. And then again, the think tanks like the Bipartisan Policy Center have actually adapted the European Commission framework to its own device, issued one report last fall, more to come. So there's lots of activity, even despite the turmoil and disarray in Washington. Lots of these things, efforts from different points of view are happening and will continue. So I take great encouragement from that. The European Commission call for evidence really set what I thought was a high bar, looking at things like how rules affect the economy to finance itself and growth, looking at unnecessary regulatory burdens, interactions, inconsistency, gaps, and rules giving rise to unintended consequences. That's a very helpful starting point, and if you can gather some facts and figures and build the logic for the case that some of these things need to be rethought, that's a pretty good starting position, and again, groups like the Bipartisan Policy Center and others have gone down that path. Your own countryman, Mark Carney, went down a similar path in remarks I heard him present in Washington a few months ago to the Institute of International Finance. And there, three of the takeaways for me was his discussion of the need for dynamic and efficient implementation of intended consequences of reform while preserving the core resiliency of what's going on. So again, to my point, I don't think you're going to see major significant changes in current levels of capital liquidity stress testing or ending policies on too big to fail. But again, through my interpretation of his words and a lot of those in the audience where he focused on the dynamic and efficient implementation, and then the last point there where he wanted to work together with all sorts of stakeholders to take advantage of this, signaled to me at least an opening at the very highest levels of the global regulatory system that there is a willingness to rethink some of these issues going forward. Let me switch now to the legislative reform. As you know, in the U.S., we have two houses in Congress, the House and the Senate. The Republicans in the House of Representatives have passed something called the Choice Act within the last several weeks. H.R. 10, creating hope and opportunity for investors, consumers, and entrepreneurs. Wide-ranging reforms. It's not the repeal of Dodd-Frank that many were talking about during the campaign, but it does repeal parts of Dodd-Frank. So the Volcker Rule, if the House had its way, is gone. The Durbin Amendment on exchange fees are gone. Title II, the orderly liquidation authority that allows the FDIC to resolve large failing banks and others, gone in favor of bankruptcy reform. The ability of the FSOC Council to designate non-banks as systemically important, gone in the House setting. It also created a so-called regulatory off-ramp, so any institution, bank that was able to have a 10% leverage ratio would be, in theory, exempt from most, if not all, of the enhanced prudential standards set up by Title I of Dodd-Frank. And finally, one of the major changes was that it changed our new Consumer Financial Protection Bureau, created by Dodd-Frank, into more of a consumer law enforcement agency with very little supervisory authority. So that's what passed the Republican House. It did so by a mostly Republican majority and party line vote. I think there was one Republican that crossed the aisle to vote with the Democrats. But largely, this was the high watermark for Republicans to make a statement based on a lot of campaign pledges in the last election that they were going to pass a major reform of Dodd-Frank. So from their perspective, they have done their work. Now, conventional wisdom says, and I happen to agree with it, that once the House-passed bill goes to the Senate for consideration, which it has to do, it is effectively dead on arrival. And I'll speak more about that. Chairman Mike Crapo of the Senate Banking Committee, I heard him speak just this past week. And he certainly, from my perspective, has no interest in taking the Choice Act passed by the House and just running it through his committee and sending it on to the Senate floor. That is not going to happen. There are pieces of that that may come out as they get into their deliberations and their markup of whatever legislation they're going to produce. But they're at a very early stage where they're just starting the hearing process. And again, they have positioned this as coming at it from a viewpoint that we want recommendations from all stakeholders on how to think about the regulatory structure in terms of promoting more growth and creating more jobs. And it was, if you think of Washington as a highly charged, highly partisan government setting, you are right, except for certain selected exceptions. And one of the exceptions would be what both Chairman Crapo and the Ranking Member Sherrod Brown from my home state of Ohio have done by putting out a joint bipartisan press release to start this initiative, almost unheard of in the current environment. But again, I think they want to take a slow, deliberate, thoughtful approach to how they're going to look at some of these issues. They will certainly be influenced by the Treasury Department report I mentioned, since the Republicans do control the Senate. Ranking Member Brown will want to get some of his points in, and in the next slide, no, I'm going to take a quick detour here. But they will take a very thoughtful, deliberate process to get into whatever reforms the Senate is going to do. During the campaign, there was lots of discussion about the need for a 21st century Glass-Steagall Act, whatever that is. The Glass-Steagall Act dates back to 1933, for those of you who may not know, coming off of the Great Depression and the reforms made at that time that put in place things like our Federal Deposit Insurance Corporation. And the Glass-Steagall Act, this one particular section, separated commercial banking from investment banking. A number of years ago, that law was amended, not repealed, but amended, to allow the affiliation of commercial banks and investment banks, and that's been the law of the land ever since. But lots of discussion about we need to go back, coming from the left, in the case of Senator Elizabeth Warren from Massachusetts, who's talked openly and quite frequently about the need to break up the big banks and reimpose all kinds of new restrictions on their activities. So that's her interpretation of what a 21st century Glass-Steagall Act. When you listen to Secretary Mnuchin, both in his confirmation hearings earlier this year and since, as he thinks about a 21st century Glass-Steagall Act, which President Trump never defined, he talks about spurring more lending for growth and job creation. Two radically different views. And his report last week put that to rest. I'm going to skip this slide. This goes through the particulars in the bill that Elizabeth Warren has introduced. again, separating commercial banking and investment banking and taking us back to the 1930s. One congressional source I found put the probability of enactment of her bill at 1%. So I don't think you have to worry about, and I would agree with that assessment, that we're going to be going back and reimposing Glass-Steagall anytime soon. The President himself talked about it and said we're considering it. I've got my people looking at it, so we're going to take a hard look at it. That's what he said in May, but it was only a few weeks later when Treasury Secretary Mnuchin said, no, we do not support a separation of commercial and investment banking. To do so would create havoc in our financial markets and upset market liquidity. So that's not going to happen. Again, reconfirmed just 2 days ago by his counselor, Craig Phillips. So as we come to the end of the legislative process, again, the House and Senate, two very different creatures, even though they're both controlled by Republicans. We've got the House action already taken, Senate pending. It's possible to filibuster issues in the Senate, not possible in the House to do that. One of the great differences is because of the quirks of the Senate rules, to start the procedure to discuss any piece of legislation, you need 3/5 of the senators voting to proceed with the debate. So Republicans only control 52 of the Senate seats. That means they need 8 Democrats to go along to start any kind of debate on the floor of the Senate. And so by definition, it means that bipartisanship is going to be required. That is why Chairman Crapo is reaching across the aisle to work with the Ranking Member Brown. We'll see where all that plays out. But my point being, we've got a long way to go on any kind of legislative relief in the near term. Let me skip over budget reconciliation in the interest of time. And again, just to underscore my point that it is possible to come up with bipartisan bills on issues that are of importance across the aisle. So consider some of the things that the House Financial Services Committee has done to date. Think of these as small bites, but as you read through just the names of some of these pieces of legislation that have passed the committee, Fair Access to Investment Research, Supporting America's Innovators Act, Small Business Capital Formation Enhancement Act. How can you be against that? And look at the votes. So these bills are passing 56-2, 54-2, 58-0. So it is possible in this environment to get things done, move things along. And if I had any prediction for what comes out at the end of our legislative pipeline, I would expect to see some relief to be determined for community and smaller regional banks. Again, a tailoring of the set of rules. So what applies to the large, globally, systemically important banks doesn't necessarily have to apply to the smaller banks. Lots of discussion concurred in by the regulators, most recently by Governor Powell, about raising the systemic threshold from $50 billion in Dodd-Frank to something higher. $250 billion in assets is a threshold thrown around for the point at which our enhanced prudential standards apply. And then other changes that can be viewed in the context of promoting economic growth and jobs or not hindering economic growth and jobs have some prospects for passing. Again, you may see changes in the Volcker Rule, potentially in some other areas. Now, let me move to stop with the legislative side and move quickly to the regulatory and supervisory side. So I mentioned at the top of my remarks, there's a saying in Washington that personnel is policy, and that's true. And if you look at the critical appointments that President Trump has to make across the independent regulatory agencies, just look at all the TBDs, to be determined slots, where positions aren't yet named or filled. We only have one new confirmed official, that's Jay Clayton, the new chairman of our Securities and Exchange Commission. We have a couple of folks who are in acting capacities. But here we are almost 6 months into the administration, or 1/8 of President Trump's entire 4 years we're coming up on, and we have these kind of vacancies. So they're behind where they need to be. If you think that the critical personnel you put into some of these slots are going to make a change. And in places like the Federal Reserve down there toward the bottom, we have a very important slot for a new role of Vice Chairman of Supervision that for whatever reasons President Obama did not fill for a period of years. It was mandated by the Dodd-Frank, and then there are 2 other governor seats that are open. So right now we're operating with 4 out of the 7 players, and once you see those nominations put forward and confirmed, I would expect to see more movement, certainly from the Federal Reserve, on some of the regulatory issues I have mentioned, and will mention some more in just a moment. This timeline shows you of the when some of these new appointments may come into place. So right now we're operating with a majority of holdover appointments from the Obama administration. Over time, those will change, of course, but for the moment, President Trump only has 3 of the dozen or so critical spots where he's been able to put his people in a officiating role. But certainly by the end of 2018, halfway through his term, he will have all these folks in place. And if you sit around the table, that's kind of a 10-sided voting table of all our many regulators in Washington around the FSOC, again, he's only got a couple people there, some in just an acting capacity. So to the extent that that becomes not a decision-making body, but a discussion body, a forum to exchange views and encourage the regulators to go forward and think about implementing some of the many recommendations in the Treasury report, for example, we have a ways to go before the FSOC becomes any kind of tool that the Secretary of the Treasury in his role as chairman of the FSOC can use to his advantage. Now, there have been some encouraging statements. I go back to Governor Powell, who, upon the departure of Governor Trullo, was named head of banking supervision for the Fed and playing that role. And in what I would call a trial balloon at the beginning of the month, Governor Powell talked about the need for change. It's timely to change. We couldn't possibly have gotten everything right as we go through all the rules that the Federal Reserve and other regulators are doing. So it's quite timely to pause and reflect and think about some of these changes. And he, in this one interview, he ticked off a number of issues that you see on the page, including one of my favorite ones at the bottom there, thinking through how bank supervisors can do a better job of interacting with boards of directors from a more principles-based approach as opposed to the check-the-box approach. And I can tell you from my role sitting on a board, we spend far too much time on compliance issues, not enough on thinking broadly about strategy and business issues and risk issues as opposed to checking off the box. So I would quite welcome a principles-based approach. Again, this is almost radical thinking in some respect. You wouldn't have heard this kind of dialogue or discussion coming out of the Fed just a year ago. Just yesterday, Governor Powell testified in front of the Senate Banking Committee, and for the first time, at least in to my knowledge, he enunciated 4 principles for reform from the Federal Reserve. Some of these have been talked about in the past, nothing this official sitting in front of one of his authorizing committees in Congress. But he talked about the need to, from their perspective, their guiding principles are the following. Protecting the core reforms for large banks in particular that are already in place. Tailoring rules to size, risk, and complexity. Note the overlap with the Treasury Secretary's report and the need for tailoring. Adjusting regulation in common sense ways to simplify rules, reduce burdens, without compromising safety and soundness. So striking that balance along the way. And then last but not least, providing appropriate transparency regarding what the Federal Reserve's expectations, whether it's stress testing, capital requirements, supervisory behavior going forward. Not a bad starting point to think about changes that may be coming. And then in his, again, official prepared remarks to the Senate Banking Committee, he rattled off 7 areas here that I picked out where the Fed, either working with the Congress or the Fed on its own, should focus its effort going forward. So he's giving lots of good ammunition and cover to the Senate Banking Committee and the legislators to go forth and start either enacting legislation or providing their blessing to the regulators to go forth and do good on their own along some of these lines. And Governor Powell, again, just recently also reaffirmed the continuing role of the U.S. regulators in international standard-setting bodies. So again, concern early on that we might be completely retreating, and Governor Powell, to my mind, put that issue to rest, that the U.S. will continue to be open and active and vocal in these different bodies. Richard asked me to say a few words about the need for advocacy and engagement, and I think it's quite appropriate to wrap up with this. Based on what you've heard me talk about in terms of the potential for legislative change and regulatory and supervisory change, continuing to be engaged as the private sector with the public sector, I think is critical. I wrote a book right after the crisis, and I've got a whole chapter about how to think about advocacy and engagement, and it starts with having a good story to tell and recalibrating language. So really thinking through how the issues impact not your institutions necessarily from a cost burden or inefficiency standpoint. That's important, but really being able to talk to the policymakers and other stakeholders from the perspective of your customers and your clients and consumers, I think is the right way to structure that dialogue. And you see a lot of that going on in Washington and other markets today, where the focus is on the impact on the ultimate end user, impact that has to flow through to the economy. That's the right starting point. From there, you build consensus either with ad hoc groups or through established groups, like some of the trade associations and coalitions you see listed here. And if issues reach a certain point, it is always, I think, quite correct to get the official sector involved, whether it's officials here working with our State Department, our Treasury Department, our Federal Reserve on a bilateral official-to-official representation to talk about issues of mutual concern. I've seen that in the past be an effective tool as well. So again, last thoughts. It is exciting times to be in Washington and elsewhere as these regulatory reviews are underway. And I think they ought to be encouraged, and they are being encouraged, and I presume many of you in this room are part of that engagement. I do worry that President Trump is potentially squandering an opportunity. I do think the chances of legislative relief are low, a bit higher for regulatory and supervisory reforms, but a lot of that has to play out along the way. And I'd like to think that they're going to have more of an impact than they may have, but unless you're a small community bank, potentially a smaller regional bank, maybe a custody bank, I think for you to think that you're going to see any meaningful improvement in your bottom line profitability or valuation, I don't think you're going to see that happen. I hope I'm proven wrong over time, but I don't see that having a meaningful impact from where I sit at the moment. And I'll just wrap up where I said a minute ago. I think as a result of all that, continuing to engage and advocate on issues of interest to you, it's critical whether you're sitting in Ottawa or Washington, D.C. So with that, let me thank you for your attention. Happy to take any questions in the minutes we have remaining. Thank you.
Okay, Greg, so again, there will be 2 mics, so please put your hand up. Just a starting question. Who do you think is driving Trump's agenda on banking and financial services? Is it sort of Gary Cohn, formerly Goldman Sachs? Is it Jamie Dimon, or is it Steve Schwarzman, or who do you see is behind the scenes here?
It's a combination of factors, right? So certainly it's his officials within the White House, so people like Gary Cohn. Also the Treasury Department. I've been over, in the course of my work, the Treasury Department several times as they were going through their Treasury report, that they ran a very open, engaging process to gather input from any stakeholder who had a point of view. So historically, even though Treasury is not a regulator, and I used to be at our Treasury Department 30 years ago, we would help to drive the administration's point of view. And then you mentioned Jamie Dimon, who sits on one of his economic advisory councils. Certainly this administration, unlike the last one, has been more willing to listen to the private sector. So he's getting advice from all different quarters, but the captain of the team, I think you really want to point to Secretary of the Treasury, MNUCHIN.
MNUCHIN, okay. Now, I think you agreed that your slides would be available afterwards, so there was a question about that.
Yes.
Someone also wondered if you had any, if you could channel your Donald Trump, what Fifi actually was trying to type. No, not possible.
No.
What's your opinion on Trump's potential for causing real long-term damage to the U.S. economy?
I actually think it's quite minimal. And here's the reason why. We are a government of checks and balances. So if you can discount a lot of the tweets that are going out there, for him to do any serious damage, he would have to work its way through either the independent agencies, which he doesn't control, through his cabinet agencies by directive, or getting Congress to change the laws. Now, it's certainly possible that some of these things go off the track or don't get done. So I'd like to think we're going to look at tax reform this year. Don't know if it will get done. If it doesn't get done, does it derail the economy? No, but it doesn't necessarily help our economy. So the short answer is I don't think he's going to, he can't do real damage to the economy without one of these other checks and balances kicking in.
Yeah. Do you, now are you
Or the court, I should mention the courts is another obvious check and balance through our court system.
Are you comfortable talking about NAFTA? Because there's a couple of people who want to know, what do you think the outcome will be for the North American economy of renegotiating NAFTA?
Yeah, no, I'm sorry, I'm not a trade expert, so I'm going to duck that.
Okay. So Trump's statements on Dodd-Frank and regulation seem to be really focused on small businesses and consumers. Where does that leave too big to fail banks?
I think they are going to, frankly, struggle to get meaningful change, and the change that they will get will come at the regulatory and supervisory level, where you don't need to change the law. So I think there is enough thinking at the, I'll pick on the Federal Reserve for the moment. There's been enough thinking and enough work done internally at the Federal Reserve to cause them to pause and reflect on a number of these issues. So there have been internal Fed studies by Fed economists saying, hang on things like capital requirements and liquidity requirements, we're actually beginning to see potentially negative effects when it comes to home mortgage lending or small business lending. You've heard some of the comments from Governor Powell, and we'll see once the other governors get on board. But there are enough issues being raised like that. They know the issues around, I didn't get into it in my remarks, about the supplementary leverage ratio. And some of the other capital requirements that are coming, where I think the Fed is going to stop and think and give a hard look at those issues, recalibrate and redefine where they can, and if there's any relief for the large banks, it will come from those kind of actions, not anything meaningful out of the Congress. But again, that's just one person's view. In the back here, in the middle here.
Do you have any views as to what the agenda looks like for foreign banks trying to operate in the U.S.? Some of these ratios you're talking about, obviously, in this home versus host type jurisdiction.
Right. Well, I take great encouragement from the Treasury report, right? So if there was any concern about the foreign banks being treated differently or put on an unequal footing, I'd like to think a lot of that has been laid to rest by the Treasury report that just came out and the one slide I alluded to, where there is some relief being granted to them. And the fact that you, again, I think have some pretty reasonable people at the Federal Reserve who would continue to buy in to the policy we've had in the U.S. for a long time of national treatment for foreign banks operating in the U.S. And it was just this week in several different settings, and the Treasury report specifically mentioned this about the positive impact that foreign banks have had when it comes to investments in the U.S., providing lending opportunities in the U.S. So if there were any concerns that you were going to be discriminated against or treated unfairly, I think you can largely put those aside, recognizing there are always going to be some little concerns over here that you'd want to continue to talk about that may or may not be wholly fair. But by and large, I would take great encouragement from the environment as I see it today.